All right, welcome to the first ever Friday feedback video, where I take the very best question from the Market Pulse Discord and turn it into a short video. This week's question comes from Axe. He says, "Hey Nick, I've often heard you say buy on strength versus buy on weakness. Would you mind elaborating on this? How would you determine whether you will buy a particular stock on strength or on weakness?" This is a great question and a great way to kick off this video series. So today we'll be talking about buying on strength versus on weakness, or as other people might put it, breakouts versus shakeouts. And for me, it really comes down to two different factors: what the overall market environment is like and the individual stocks characteristics. So in this video, I'll go through both of those and then give pros and cons of both buying on breakouts and on shakeouts, on strength or on weakness. So I'll turn my video camera off so we can see more of the presentation and get into it. So first off, why is it important to have separate entry tactics? By adjusting your entry tactics to fit the current market environment and the individual stock's characteristics, it can help you improve your win rate and skew the risk reward further in your favor on every single trade. First thing I wanted to cover is the overall market. So what you need to determine is, are you trading in a trending market? That could be trending to the upside or trending to the downside, or a chopping market where you just chop higher, chop lower, and every day is kind of an adventure. So, in a trending market, these are characterized by persistent buying pressure from institutional investors. You'll see pullbacks are shallow and breakouts are powerful with follow through. So, not just a 1 day move, but multiple days in a row, we see accumulation. You often see bad news get absorbed quickly as buying opportunities if you're trending to the upside. And on the flip side, good news is seen as selling opportunities if you're trending to the downside. And then on the right here, you see a nice clean trending market from this was May 2025 up until I think late July, early August. And what you can see here is the 10-day moving average exponential and the 20-day exponential. Those are the two that I use. There's no magic in those moving averages. But in a trending market, you'll see price typically be above the 10-day and on pullbacks get supported right around the 20-day moving average. If you close under it a day or two, it's not a huge deal. But what you want to see is those shallow pullbacks followed by a either gap up or strong action to the upside and then follow through. Where in a chopping market or choppy market, you'll see it's pretty emotionally draining as a retail trader trying to buy breakouts in. You'll see institutions will de-risk from certain stocks in certain sectors while moving money elsewhere. And it's typically categorized, or it typically comes after an extended uptrend. So in a trending market, typically we want to buy on strength. For me, I love to buy on weakness and shakeouts as well, even in a trending market. But the only time that I will buy on strength is in a trending market. So, more kind of characteristics of a trending market is you'll see narrow daily ranges. So, take a look at whatever index that you mostly track. I track the QQQ, SPY, IWO, which is the growth stocks of the Russell 2000, and then ARKK. And what I'll do is I'll just have a quick checklist to see, is price above the 10-day? Is it above the 20-day EMA? Are those moving averages in the correct order? And of all the individual like ETFs or indexes that I track, how many of them are in that kind of not a technically a power trend, but price over the 10-day, over the 20-day? If all four of the indexes, you have price over the 10-day, over the 20-day, and we see nice narrow daily ranges, that is a trending market that I would be willing to buy on strength. You'll also see an expanding of groups of leadership, whether coming off the bottom in 2025, we first saw like aerospace and defense. Then we added semiconductors. Then we added precious metals. Then we got some of the nuclear names going. All throughout that uptrend, we got expanding of leadership. You'll also see stocks break out on heavy volume and not just have one single day moves, but expand on volume and then continue to be accumulated. And that's a sign of institutions stepping in and bidding up the stocks. Oftentimes, if you see just a single large volume up day and then the stock just rolls over, that was just day traders or retail swing traders trading the stock. But if an institution wants a stock or an institution wants in on the indexes, you'll see persistent buying and a strong uptrend. And then personally, look through how your last 10 trades have gone. Are you getting lower win rate than the average? And this is why it's good to track your average win rate. But are you turning over your trades very frequently? Are your average duration of your holds going down or up? In a very strong market, you'll see, hey, I'm putting on stocks and I don't have to sell them at all for multiple weeks. That's a sign of a very strong market. Lately, I've had to put on trades and then take them off within the day, and that's signs of a choppy market. So, kind of using your own feedback as the stocks that you're trying to trade is a good way to understand what type of market environment that you're in. And then when you are in a trending market, buying on strength is perfectly reasonable. Pivots provide clean entries that multiple traders and multiple groups are watching. You'll often see on Twitter where people say, hey, this stock is followed by too many people, or so many people are watching this breakout, so it won't work. They said that about NVIDIA in 2023. That broke out. It was a beautiful, beautiful breakout. They talked about that in SMCI right at the beginning of 2024. That was an amazing breakout. They talked about that with Palantir. In a strong market, it doesn't matter if the setup is obvious. You want the setup to be obvious so multiple people are buying those stocks. And in a trending market, we want to be taking our profits a little bit slower because the whole goal of trading is to get money into the liquid leaders in the leading themes. And if you're in a strong market and you're properly buying the leading stocks and the leading themes, those will go on for multiples of your risk. So instead of taking profits at one or two times your risk, you can let them work a little bit longer, try to stick in with larger size, and really take advantage of that strong market. In a choppy market, basically everything is reversed. You see very wide daily ranges on the indexes, lots of volatility. Whenever you think you should be long, that's probably a good time to go short. Whenever you think you should go short, that's probably a good time to go long. Price, you'll see cross back and forth over the 10 and 20-day EMAs. The key moving averages are crossing over each other, whether it be the 5, the 10, the 20, the 50, whatever you use to kind of track the indexes. And you'll start to see leading stocks and leading groups start to break down. You'll also see a high turnover rate in your last 10 trades, like I'm seeing recently in the market. And these are all signs that we're not getting follow through in the market. Institutional risk appetite is just not there. So, in those environments, we don't want to be buying on strength because we have evidence that institutions are using liquidity to kind of de risk. So, instead of buying at a pivot, you'll see an uppercut and failure often at those pivots. Instead, we want to be buying on an undercut and reclaim or an undercut and rally of key areas that provide the best risk reward, whether that be a support gap, a previous low, a key round number, a key moving average, somewhere where you want the most number of people to be stopped out. So when you enter the stock, there should not be any more sellers, and you should see immediate kind of reversal from that area. In this environment, profits should be taken quicker. Your first trim should be at a lower multiple of your risk because you're in an environment where we do not see follow through. Next, why is it important to understand the stock's character or the characteristic of the stock? By reviewing the price action of a stock every single day, you get a better feel of how it acts, what moving averages it respects, how does it have false moves in the morning? Do buyers step in later in the day? One thing that kind of changed my trading was instead of scanning for a certain setup every single day, I only scan for high volume moves every day. And then at the end of the week, I do a 52-week high scan and a liquid doubler scan. Then I have a universe of stocks that I track every single day. So I deeply understand where this stock is in its price cycle and how it moves. So buying on strength versus buying on weakness for individual stocks. You, for me, would be able to buy on strength if it's a liquid institutional favorite. Think $1 billion dollars plus of average daily volume. If you have a smaller account, maybe that can be a little bit lower, like $500 million. But the more liquid, the better. those tend to trade a little bit cleaner. Strong uptrends above key moving averages with no overhead unfilled gap downs. So you want a stock that's already kind of broken out of its initial base and should be trending higher without any overhead gaps. If you checked out my channel before, you know I talk about the gaps very often. Overhead gaps, that just shows you that there's sellers above. So if you're trying to buy a breakout into a gap zone where there's evidence that there's sellers, you're going to have a lower win rate and lower risk reward. You also want to be buying on strength when it's a liquid stock in a leading theme. So some stocks you just have to own, right? If it's your Nvidia, if it's your Palantir, if it's your Robinhood, Coinbase, the true liquid leaders in leading themes, it's worth the additional risk to get positioned in those names because they're going to be the ones that can really move your portfolio. Now, I will buy on strength and buy on weakness for everything we covered on the left side there, but only buy on weakness if we see undercut and reclaims of key areas that provide the best risk reward. So if I'm buying an undercut of a support gap of a key moving average, my stop of the day is going to be, or my stop is going to be the low of the day. And if I'm buying on that shakeout, that's going to be a 1 or 2% stop. So with a 1 or 2% stop, I can size that trade up a little bit more aggressively and still keep the portfolio risk the exact same. Where if you're buying on strength, you have to size down just a little bit because your stop is going to be a little bit wider. Buying on strength, you or buying on weakness, you also want to use that as your entry tactic if you're buying a stock within its base. So Tesla was a great example of this. It was super frustrating to trade as it kind of filled out its base back in I think that was August, September. But the best times to buy were at the higher low pullbacks to the 200-day moving average to a support gap. And then as it broke out, then you could buy or then you could add on strength. But within a base where you're seeing a stock rally back up and get rejected multiple times, you don't want to be buying on strength every single time and then just getting stopped out over and over and over again. Try to build a position as the stock's in the base, and then as it breaks out, that could be an ad spot. And then buying on weakness, you definitely want to take your profits a little bit quicker, like I mentioned. So the pros and cons, buying on strength versus buying on weakness. So buying on strength, the pros, you should get immediate traction and persistent follow through. So if you buy a Nvidia coming out of a 6 month base, that is a stock that everyone is watching, and it is going to be a liquid leader. When you buy on that breakout, the best breakouts, they never look back. Now, there are breakouts that do kind of check back, breakout retest, and that would be a spot that you would buy on weakness. But the best breakouts, I've noticed, they don't look back. Everyone is looking at that one spot. You're going to see a huge spike in volume, and then it's off to the races. And another benefit of buying on strength is if you're focused on like the leading stocks in the leading themes in the market, those stocks will go massively higher. Um, the cons, you have to have typically you have to have a wider stop, and unless you use like a low of day of that day. When I'm buying on strength, I usually use the previous day's low as my stop, and you're paying a little bit higher price. Now, the trade-off of that is you should be getting immediate traction on the breakout and persistent follow through, but you're going to be paying up a little bit more. The pros of buying on weakness is you should still get that immediate traction because you're trying to buy right after everyone gets stopped out. So you're still kind of buying once you see strength after that shakeout, whether it be a support gap, whether it be a key moving average, round number, previous low in the pullback. You want to look for your entries right where everyone else is putting their stop losses. So once those stops triggered and there's a rally back up, then you enter the stock. Your stop would be the low of the day. Very, very tight stop loss, very skewed reward to risk in your favor. But when you're buying on a shakeout, many times you'll see the shakeout. it'll kind of snap back, so you'll have that immediate traction. But then for 3 or 4 days, it'll chop sideways as it builds the pivot. You'll get the best price. And once we go through that pivot, the people that are buying on strength, they'll push that stock up for you. But you will kind of have to sit with the stock that just chops sideways for a day to 3 days after that immediate like reversal. The cons are the stalling action that I just mentioned after the bounce from the pivot. And you could be buying a laggard or a stock that's starting a downtrend. If you're buying a stock pulling back to a key moving average, the momentum is to the downside at that point. But if you are focused on the liquid leaders and the market's not going to just completely roll over, you're going to get a liquid leader at the very best price. So, buying on strength versus buying on weakness, every trader has different personalities, different strengths, different weaknesses themselves. I found that aligning the market or the entry tactic that fits your personality, the market environment, and the stock characteristics will give you the best odds at winning in the market. And just want to say thank you, Axe, for that question. Great way to kick off the Feedback Friday series that I'll be doing. If you're in Market Pulse already, use that question and answers portion of the Discord. Leave a great question. I'll do a video each week on that. If you're not a part of Market Pulse just yet, you can use the link in the comments to sign up. We do a live stream throughout the trading day. I stay on for about the first 2 hours. I post all the trades that I personally take and then answer all the questions. So thank you for this great question, and I'll see you guys in tomorrow's video for the weekly prep. Have a great night, and I'll see you guys tomorrow.